Hey, what's going on everyone? It's Griffin here, and in today's video, we'll be covering 5 exchange-traded funds, ETFs, right? What's not to love about exchange-traded funds? With one single holding, you get that diversified exposure to multiple different stocks, all for a relatively low management expense ratio. And in general, these can represent some of the most consistent and steady returns for retail portfolios. And you might actually be shocked to know that worldwide, there are over 7,600 exchange-traded funds available, with Canada and the United States representing some of the largest pools of exchange-traded funds available. That's a lot of selection to choose from. I've personally been using what I consider to be core exchange-traded funds along with some more narrowed down market and industry focused ETFs for years. And other than a handful of other individual companies that I like to hold in my portfolio, exchange-traded funds represent one of the largest financial vehicles that I use in my portfolios for those more consistent and steady returns over time. So let's just get right into today's video. As mentioned, we'll be covering 10 exchange-traded funds in 5 different categories, one Canadian and one American option for each. All right, so the first type of exchange-traded fund that I want to highlight in today's video would be a mid-cap growth stock fund. And what I mean by this is an ETF that invests specifically into growth-oriented stocks that are also categorized as being in the mid-cap range. So this is a company that would have a market capitalization in between the $2 to $10 billion range. Now, I'm not sure if you might remember from a video that we made a couple of months back where we were speaking about how the overall broad stock market is getting quite pricey right now, with the average S&P 500 PE ratio approaching a very high level. This has a lot of investors questioning the future of this past year and a half bull market and therefore trying to find maybe some better value in other areas of the market. And one of the main data points that we had highlighted in that video was the fact that the relative value of small and mid-cap stocks in the American stock market weren't priced nearly as high as large cap stocks, potentially leaving quite a bit more room for growth in the midterm. So a Canadian ETF that could capitalize on this facet of the market moving forward would be the iShares Mid-Cap Growth Stock ETF, ticker XMH, which currently trades for right around $25 per share, making it extremely accessible to all investors. This is an ETF that tracks the S&P Mid-Cap 400 Canadian Hedged Index. And by the way, iShares does also offer a non-Canadian hedged version under the ticker symbol XMC. The main difference here between a currency hedged versus non-hedged ETF is that with, say, this Canadian hedged ETF, you'll actually make a better return on investment if the Canadian dollar appreciates in value relative to the US dollar, which is what we have been seeing over the past year or so. And that's why this Canadian hedged ETF has actually had a better return on investment than the American version. So with the American dollar having lost substantial relative value to the Canadian dollar over the past year, the XMH ETF has actually performed the best. With that said, historically speaking, when you average out this data over a long enough period of time, currency hedged ETFs tend to actually perform less well than non-hedged ETFs. So if you do want some more information about how this works and how currency exposure will impact your investments, make sure to check out this video that I had made right here about a year back. It is really thorough, going through everything you need to know about currency exposure in the stock market. Back to this ETF though, as the name would suggest, it provides exposure to mid-cap companies spread across multiple different industries. The main ones being industrials at around 18%, financials at 15%, and then consumer discretionary at around 15% also. As with most equities, the ETF has ran quite a bit over the past year and a half, with relatively flat movement though since April of this year. The fund has net assets under management of just above $100 million, and you'll notice that other than some cash, its only holding is the iShares Core S&P Mid-Cap ETF, ticker IJH. And what this is essentially the exact same fund that trades on American exchanges though, so this Canadian version is receiving the exact same stock coverage and returns. In fact, the American version, ticker IJH, has over $60 billion in net assets under management, with 400 equities in the fund. One thing that is somewhat frustrating as a Canadian investor is that the XMH ETF has a management expense ratio of 0.16%, while the American version, which we just saw is essentially identical, has a management expense ratio of 0.05. This is quite typical of Canadian exchange traded funds though when compared to their American counterparts, and in reality a 0.16% MER is not a big deal in the larger picture. $10,000 invested into this fund would represent about $16 in management fees. So again, not really a big deal, and considering the performance of this fund over the past 10 years, this definitely justifies this management expense ratio. Speaking of returns, we're looking at average returns of 10.39% per year since inception, and average returns of 12.3% per year over the past 5 years, which realistically is fantastic for a passive fund such as this one. It also happens to have a 0.84% trailing 12-month yield, which isn't anything fantastic, but is better than nothing for those looking to add a little bit of extra dividend income to their portfolio. The next ETF on the list is the Horizons Nasdaq 100 ETF, ticker symbol HXQ in the Canadian markets. This is an ETF that I honestly can't even count the amount of times I have mentioned it on the channel, but there's good reason for this. It's an ETF that invests in the 100 largest American and international companies that trade on the Nasdaq exchange. And just by the nature of the companies that tend to trade on the Nasdaq exchange, well, this inherently means that there will typically be a much higher portion or weight of this fund associated with companies that are in the information technology industry, right? So companies that specialize in financial payments, big data, digital advertising, and so forth. In fact, almost 50% of the fund is made up of companies in the IT industry, followed with 20% of the fund in communication services and around 17% in consumer discretionary. From an individual holding standpoint, this puts Apple as the largest holding, followed by Microsoft, Amazon, Facebook, Tesla, and Alphabet. So the holdings in this fund are mainly American large and mega cap companies with valuations that are quite rich right now. But keep in mind that this is a weighted ETF, meaning that the weight associated with each position within this fund is constantly in a state of flux to best represent the top 100 companies on the Nasdaq. This is also a position that I consider to be a core ETF, and personally I've been dollar cost averaging into this fund over the past 5 years regardless of price, and over this time it has translated into fantastic returns considering how passive and hands-off this investment truly is. Currently, one share of HXQ trades for around $52 per share, and this is after just recently going through a stock split after it surpassed the $100 per share mark. The fund has $315 million in assets under management and does not pay out a distribution. This is strictly a growth-oriented fund. Now, the management expense ratio for this fund is on the relatively higher side of things at 0.28%, but considering the fact that this fund has historically performed above total market returns, this isn't an MER that deters me. Average returns of the HXQ fund over the past 5 years have been 25.33%, while the year-to-date returns have been 13.96%. And by the way, if you're an American investor looking to also gain exposure to the Nasdaq 100, a great option that I also personally hold in another American dollar portfolio is the QQQ fund, which also tracks the Nasdaq 100. I really hope you're enjoying today's video, and by the way, if you've been following my channel for a while now, then you would know that I'm a strong advocate of properly diversifying your broader portfolio to hold more than just one single asset class. And recently there's been a new asset class that has come on my radar that I had never even considered before, being contemporary art. I'm always on the lookout for new and interesting investment vehicles, and the type of appreciation that contemporary art has been seeing definitely grabbed my attention. From 1995 through to 2020, contemporary art prices have actually outpaced the S&P 500 total return by 174%, and according to Citibank, contemporary art has one of the lowest correlations to the stock market out of any major asset class. Here's the thing though, most investors don't have $2 million lying around to drop on a Banksy piece, and so it turns out that there's this platform called Masterworks that gives people like you and me the opportunity to invest in iconic pieces like the Banksys of the world. It's actually pretty simple. Masterworks does all of the legwork to purchase art from what their team of acquisition experts determine as blue chip caliber. Then they file each piece through the SEC as a Regulation A+ offering so that you can go on their site and purchase shares to invest in that particular piece of artwork. Right now, it looks like they've launched over 50 paintings for a total value of $150 million, and you can easily browse through the current offerings to choose the piece that you find most appealing, while also reading into each piece's offering, circular, and Masterworks investment thesis. And so for today's video, I actually partnered with Masterworks to give you all the opportunity to skip their current waitlist that represents thousands of individuals right now if you use the link down in the description. You can click down there to learn more and possibly start investing in contemporary art. Moving on though to the third ETF on today's list, this is a fund that I was somewhat reluctant to include in the video because over the past year, the value of the underlying holdings have shot up in value dramatically. And this has obviously had an impact on how expensive the ETF is on a fundamental level and can therefore impact the volatility and risk of the fund right now and moving forward. But since so many viewers have recently been asking me to speak about Lightspeed, Constellation Software, and Shopify, well, I wanted to include the iShares TSX S&P Capped Information Technology ETF, ticker symbol XIT, in today's video. This is an ETF that seeks to provide investors with exposure to the Canadian IT sector, which, with the introduction of some new and notable companies in this field over the past decade, has entirely changed the Canadian IT landscape. In fact, we can see that from years 2001 to around 2013, this fund severely underperformed expectations, but as of around 2014, things changed quite rapidly following the introduction of new and innovative firms. So yes, XIT is an ETF that I personally hold in my portfolio. It's been around 2 years now, and over this period of time, it's performed tremendously well, having exceeded the analyst expectations for these underlying holdings. In fact, the largest holdings include Constellation Software at around 25% of the weight, Shopify at around 25% also, and then CGI at 15% and OpenText at around 11%. The fund has just above $550 million in net assets under management, spread across 19 holdings, and barely has a distribution yield. This is a tried and true growth ETF if there's ever been one. And as mentioned earlier, the relative PE is very expensive, currently sitting at around 63x, which is unreal expensive. So definitely be aware of that fact if you do choose to add this ETF to your watch list or even potentially your portfolio. The fund has a more pricey MER also of 0.61%, and performance over the past year has been highly above market returns at 32.88%. Over the past 5 years, the average return of this fund has been 33.5%, which is absolutely stellar. I will leave you with this though. Prior to the returns of Shopify, Constellation Software, and Lightspeed, this fund was basically to be avoided. And right now, following these tremendous runs, it is quite pricey. And so the future state of what this ETF could represent for investors is somewhat uncertain, in that if the Canadian IT sector does continue to innovate and continue adding new and innovative firms, this could definitely still be a cool option to hold in your portfolio for a mid to longer term hold though. I will stress that right now it is very expensive. So if you do consider adding it to your portfolio, make sure that you're able to stomach high levels of volatility in the midterm. The fourth ETF on today's list brings us back down to a more core and consistent holding that you can pretty much never go wrong with. It is the Vanguard S&P 500 ETF, ticker symbol VFV on the Toronto Stock Exchange. I won't spend a ton of time covering this ETF since it's a core ETF that I've spoken about numerous times on the channel, and you're most likely aware of it and its benefits to retail investors. I'm of the mentality that 90% of retail investors should be leveraging exchange traded funds in their portfolio, because for the consistency and level of passivity that an ETF like VFV offers, this is very hard to accomplish when hand selecting stocks, let alone trying to beat a 10% average annual return. Similar to the HXQ ETF that we spoke about earlier, I consistently dollar cost average into an S&P 500 ETF like VFV every single month, regardless of market price. And even though, as we did speak about earlier, the average market cap, or value I should say, of the large cap American tech stocks has risen quite a bit, well, this is still not something that phases me. If the market sheds off, say 20, 30, 40%, as we saw at the tail end of 2018, or in in March of 2020, this is just for me going to be a buying opportunity once again, where I'm just going to continue dollar cost averaging. And if the market does drop substantially, I might allocate quite a bit more of that capital to that type of position during this period of time when it is significantly lower in market value. But over time, this is a type of ETF that, again, I consider to be a core portfolio holding that'll just continue investing into over the next 20-30 years. So as mentioned though, my ETF of choice in the Canadian market for the S&P 500 is the VFV ETF. It has a management expense ratio of 0.08%, which is among the lowest that you can achieve here in Canada. The fund has $5 billion in assets under management and a 12-month dividend yield of 1.12% at a quarterly distribution schedule. Top holdings are mostly concentrated in information technology, healthcare, and consumer discretionary, with 83% of the companies being large cap stocks and 12% being mid cap stocks. Interestingly, even though the average PE is quite high at 27x, we're seeing an average earnings growth rate of 19.3% per year, which is some crazy average growth across the US market. And by the way, if you're an American investor, a great alternative in the American market would be the SPY ETF or the VOO ETF. Those are two great S&P 500 ETFs that offer extremely low management expense ratios. And finally, the fifth and last category of ETFs that we'll be highlighting in today's video is a small cap ETF. For the Canadian option, we'll be looking at the iShares US Small Cap Index ETF, ticker symbol XSU, which is also a Canadian hedged ETF, by the way, but this fund seeks to provide exposure to 2,000 small cap US stocks, all within one single holding. Similar to the mid-cap stocks, small cap stocks have been showing relatively nicer value over the past couple of years than what we're seeing right now for large and mega cap stocks. So this could represent an interesting alternative ETF. The ETF currently trades for around $45 per share and holds, once again, roughly 2,000 stocks, hence the Russell 2000, which is the index that this fund tracks. The net assets under management are just above $550 million, and it does have a trailing 12-month yield of 0.64%. The sector breakdown for this fund might actually be of a surprise to you, with 20% of the fund focused towards healthcare, as this is a rapidly growing industry in the United States, followed by financials at 15%, industrials at 14.4%, and then information technology at 13.7%. Once again, similar to the mid-cap ETF, this fund is mainly composed of the IWM ETF, which is the American equivalent of this fund. Basically, this allows Canadians to invest within the Canadian market and in Canadian dollars to get that same exposure as the American alternative, even though this Canadian ETF is essentially just holding another ETF in it. The management expense ratio is also right in line with the mid-cap ETF at 0.36%, and fund performance has been insane over the past couple of years, with average 10-year returns at roughly 11.14% annually, and over the past 1 year, nearly 60%. So once again, ETFs are a great investment vehicle for retail portfolios. I personally use them in most of all my portfolios, and I would highly recommend you check out some of the ETFs that we spoke about in today's video. If you enjoyed it, make sure to drop a like on the video. It really helps the channel out, and comment down below which one of these ETFs you think is most promising for the end of 2021 and moving into 2022. If you want to learn more about stock market investing, by the way, highly recommend that you check out this video right here. It is an hour-long, basically free mini course that I created going over everything you need to know to just get started with stock market investing if you're new to stock market investing, or even if you just want a refresher on some of these core topics. Also, make sure to check out all the links down below to resources I use and recommend if you're a new to intermediate investor. And with that said, if you want to learn more about stock market investing, subscribe to the channel, hit the bell button, and on that note, I will see you in the next video.